Dino Zuccollo, good to be talking with you. As you reminded me a moment ago, the last time we saw each other was in the WeWork building that goes back a few years.
It feels like, it's funny how life works, Alec. It feels like a long time ago, but now we talk and it feels like it was yesterday.
Yeah, isn't it just like that? Westbrooke Alternative Asset Management. Just before we go into it, it's a really interesting story we're going to be talking about in a moment, an opportunity for people who are looking for higher yields and lower risk, or along with lower risk. Just tell us a little bit about Westbrooke. You're not just in South Africa, also the UK and US?
Yeah, sure. So the Westbrook story, Alex, starts in 2004 when the group was formed, originally with a view to investing in private equity assets around South Africa predominantly. The group was founded by an individual, Martin Sachs, and his partner, Rob Furrer, who in turn is a part of a business called Capricorn Capital Partners, with some prominent families sitting behind it. The original idea of the group was to invest controlling stakes in businesses around South Africa that we invested our own group capital only. We've successfully done that for more than 20 years. Some of the assets in that business include the likes of Coricraft Group, which we sold to the Fashini Group earlier this year. But in 2012, we started Westbrook Alternative Asset Management. And really the idea of Westbrook Alternative Asset Management is it's the vehicle where we bring clients along for the ride. We're the biggest investors in everything that we do. We invest principally into things that we want to invest into. But there's some markets where you need client money to help you to achieve scale. And to your point, today we manage about 8 billion rand across 3 geographies, South Africa, the UK, and the USA. And really the idea of Westbrook Alternative Asset Management, Alec, is that we invest clients in the world of alternatives. We can touch on what they are maybe if you'd like, a little bit more detail. In a highly aligned investment model where clients benefit from the fact that they are invested alongside people who have a good track record of success and also have material amounts of their money alongside them. What we benefit is clients help us achieve scale in our key markets of operations.
So you're the biggest investor?
In the products that we invest into in each fund, correct. I mean, it differs in time. It begins that way. Obviously, at a point, it becomes hard to sustain that level if you get too big. But certainly, or let's talk through the ecosystems. The ecosystem, Alec, is we invest our own money first and only our own money. We test concept. We ensure that things work the way they say. And then second round is generally friends and family. Third rounds into things are our high net worth base of clients. And then fourth round, we sort of begin to open the offering up to a wider base, which in our instance is generally a very large base of wealth managers around the country who support us.
We are here to talk more particularly about private debt funding. Now, I, as an owner of a private company, something like this appeals to me. It's I'm not that I need the capital, thankfully, at the moment, but often one does see opportunities, and so I'm talking to you now not only as someone who's engaging with you to find out more about it, but also as a prospective client. So just unpack it for me. Let's just say I wanted to buy a company, and I had a private business which was profitable and is well funded and well structured. How do you start from that side? And then secondly, how do people invest in this alternative asset class?
Yeah. So I mean, it's an interesting thing, alternatives in general, Alec, because what you're doing at the underlying is you're making, in this instance, a private loan, which in many respects is similar to private equity style investing in nature. You're due diligencing businesses, you're working out their cash flows. In some instances, it's real estate as opposed to businesses, etc. But at the top level, what you're doing is you're running an asset management structure. So it's like a little bit of a hybrid where I suppose the traditional investment public are used to a lot more investing in things like listed equities and fund of funds vehicles, which is all very much in the world of listed and liquid. So, I mean, let's take a step back. Private debt today is the world's third largest alternative asset class, got about $1.4 trillion in assets under management, and really gained prominence after GFC in 2008. What happened in 2008 is we had Basel, And the response from Basel was that obviously there was a very, very steep increase in the level of regulation that specifically focused on banks. And that made it a lot harder for banks to put out money. And so banks in turn pulled back, and what they did is they withdrew from certain areas of the funding markets. And those areas of the funding markets, Alec, they generally withdrew from were in respect of making smaller sized loans or loans for shorter durations, because what they worked out quite quickly is that if you want to put out more money, or if you want to put out less money, should I say, it's much harder to make a return given the level of implementation cost. And so really, what is private debt? Private debt is the asset class where any non-bank lender provides a loan to a company. And following GFC, non-bank lenders have taken sort of specific interest in the asset class, because what one is able to do if you invest right is you can get higher returns potentially than the level of risk that you need to take. And at least from our perspective, we're all about, maximizing the spread between the risk that you take and the return that you get in exchange for it. So to go back to your scenario, we operate in two jurisdictions, being South Africa and the United Kingdom, specifically in the private debt space. We've moved into the US, but not for clients just yet. And in each of those geographies, we exploit specific niches in the markets where we don't think that the banks are playing substantially.
Okay, so what would I be paying interest-wise? In other words, would I only go into the private debt market if I couldn't raise money from a bank?
So there's different reasons that you can't raise money from a bank. You might not be able to raise money from a bank because the bank doesn't want to do a loan to you. Now, that's the kind of thing that we don't want to be doing. You don't want to be the lender of last resort. But there are many other reasons that banks, for whatever reason, can't do a loan. The areas we like to specialize, Alec, are as follows. There's some rules that banks employ. So if we use the UK as an example, there's a rule. Loans of less than £20 million, banks don't like to do it. Now, in South Africa, times 20 to the pound, you can make a 5 to maybe £10 million loan. That's 200 million rand. It's actually quite meaningful to us. So we play A in smaller tickets. We play B in shorter durations. So we're actually quite happy to make loans of, let's say, 12 months or 24 months, where banks, if they're going to go through all the work, want to make 5-year lends. And the big thing for us is speed and complexity. Being a small entrepreneurial business, we're able to turn answers to our borrowers much quicker than what the incumbent lenders are doing. And so that's where we're seeing a lot of opportunity. Generally, if you find a good borrower, it doesn't mean that they're not going to be able to get money from the bank. It just means that they're at the back of the queue. And sitting at the back of the queue might take you 6 months to get a loan from a bank, but you might only have 2 or 3 weeks. And so in that instance, we're replicating many of the credit metrics of what a bank would give, but at a higher rate. And really the reason we're charging a higher rate is for speed and shorter duration.
And who comes along with you in those loans?
Well, so in that instance, we would be the only lender. And now we start to talk about the differences between the different offerings, right? So obviously in debt, there's many areas that one can play. You can be a senior lender, in which case you are either the primary lender or the only lender. You can be a mezzanine finance provider, a second charge senior provider, a pref equity investor, and so on and so forth. What we're trying to do predominantly, Alec, in our private debt offering for clients is to provide senior secured loans to companies. So in general, it's just us as a lender. In some instances, there are other lenders, but it's in the minority, not the majority. And then it's either in partnership with the owner of a business, so a sponsor that we, or an owner that we back and trust, or it's coming alongside, for example, a big private equity player who's looking for a culturally aligned, nimble lender to facilitate their growth into the future.
You said that it's the third largest asset class at the moment, but certainly from the information that you provided me and helping me to research this beforehand, Preqin's Global Private Debt Report shows that it's growing rapidly, and that growth is actually gathering momentum. Why would that be, and how far are you from becoming the number one in this, or rather, how far is private debt from being the number one area in alternative investments?
Yeah, well, I suppose that the answer to the second part of your question is it depends what happens with the wider markets. But let's talk about private debt for a second. We've spoken about the borrower proposition. So why do we lend to particular types of businesses? And just to add a comment to that, those niches differ depending on the country. So the UK, we're very real estate lending centric. South Africa, the big banks are actually quite good at lending on smaller ticket sizes or in complex deals. They've gotten, the Investex RMBs of the world have gotten a lot more used to fishing in a small pond. So in South Africa, the nature of what we do is slightly different, and there's other areas of focus there. But let's move, to answer your question for a second, to the investor proposition, Alec. So where do we find ourselves at the moment? We're in a world where we have high inflation and rapidly increasing interest rates. Rapidly increasing interest rates as a consequence have resulted in equities getting, by and large, smacked. I think it's probably fair to say. And at the same time, bonds respond, especially in fixed rate bonds, with mark-to-market losses and a lot of volatility. So we've got a base of clients out there who are saying, look, I have to invest somewhere because inflation is so high that if I don't invest, I'm going to find myself in a position where I get poorer in real terms. But I don't want to invest in equities because I'm perhaps a little bit concerned around the potential for equities to lose money into the future. I don't really want to go into bonds because of this volatility and the potential for mark-to-market losses. But if I sit in cash rates, albeit that they're increasing, are still low. And therefore, I'm going to get poorer in real terms and eaten by inflation. And so increasingly, clients have looked over the last while for alternative areas or ways that they can enhance returns without necessarily needing to take more risk. And I mean, if you get into the returns in the South African context, our private debt strategies are able to deliver, call it 13 to 14% net in rands to clients. In the UK, we're about 9% plus. There's a host of other benefits, things like lack of volatility, you don't have market adjustments, the returns are somewhat uncorrelated. But I think the answer to your question is that the rapid growth and demand from clients has been predicated by the tough market environment in the traditional markets. And that will continue for as long as things stay tough. But even if things don't stay tough, Alec, I think, if you look at the experience we've had, for example, in North America, you've heard names like Blackstone and Brookfield and KKR. The UK, Aussie are similar. Generally, in client investment portfolios, the allocation to alternatives is 20 to 30% of the well-diversified investment portfolio. And so I suppose alternatives need not necessarily just be a response to a tough market. I actually would advocate for it becoming a mainstay in a well-diversified investment portfolio because of the benefits, some of which we've touched on.
So you'd have a slice of your portfolio then that goes into alternatives. And today, 9% in the UK and 14% in South Africa sounds incredibly good. A couple of years ago, when equity markets were flying well, people would say, no, I can do better elsewhere. It's that diversification story, and I suppose the change in circumstances.
Yeah, well, remember as well that alternatives are not just private debt. Private debt is one type of an alternative. An alternative, for me, I hate the word. I feel like it's the globally accepted word, but alternative. If you say Alex a bit alternative, it doesn't always have a positive association. For me, the better word is private market assets. Any investment that is not liquid and that is not listed is technically an alternative. And so, the ecosystem of alternatives, Alex, spans private debt into what we call hybrid capital, which is pref and mezz instruments, a little bit riskier, but higher return stuff, into equity. The big alternative classes there are things like real estate is probably, the biggest in the world. And then on the higher return side, into the world of private equity, venture capital. And then there's a whole sort of spectrum of what I refer to as the fringe alternatives on the end that we don't touch, but technically one could consider to be alternatives, things like cryptocurrencies and classic cars and art collections and so on and so forth. So no, I think private debt, the concept of a higher return for the level of risk you need to take in this market makes private debt particularly relevant at the time. If we were in a different market, it doesn't mean alternatives aren't relevant. It just might mean that you might want to be overweight a different type of alternative.
So with private debt, do you get much of a premium in your return over liquid investments, fixed interest, bonds, even Eskom bonds at the moment, which is an interesting point, but we won't go there today. But would you anticipate that private debt, because it isn't that liquid, would actually have to give you more?
Yes. So, some might explain it that way. Some might say that the enhanced return that you're getting from making a private debt investment is due in part to the lack of liquidity in the investment. So you're earning an illiquidity premium, right? Let's look at that for a second. So again, to go to our UK investment strategy, the way it works is you would invest, you are locked in for a period of 18 months, at which point thereafter you can give 6 months notice. In South Africa, you are locked in for a period of 12 months, and thereafter you can give 6 months notice. So you are definitely locked in for a period of time, and absolutely that commands a premium relative to the listed markets. You've always got to be careful when you compare to bonds, and I'll tell you why. A lot of people like to compare a 2-year lock-in private debt investment to, for example, a 10-year government bond. They're not the same thing, because you're running 10-year duration risk on a government bond, which gives you a much higher element of mark-to-market risk in that investment in the listed space. So what you've got to do is you've got to compare, for example, a 2-year lock-in private debt investment to some form of 2-year duration product on the other side, if that makes sense. And so I like to compare private debt a lot to fixed income. What can you get on a 24-month fixed deposit in rands in South Africa? Probably 8.5% to 9% at the moment. The spread to private debt with us is 14%. In the UK, on a 2-year fixed deposit, you're probably at 3.5% to 4% in sterling, whereas our products generate 9%. And that's a more comparable mechanism. I think then there are softer elements. For example, by playing in alternatives, you can get cleverer with things like tax structuring. Fixed income will generate fully taxable income. Alternatives, if you're with a good manager, don't necessarily need to be the same.
And risk?
Risk is actually the question, Alec. And it's interesting because there's some borrowers that we've got in our private debt funds where those borrowers actually also have listed bonds. And by definition, a listed bond is an unsecured claim against a company, whereas as a senior or as a lender into the business, you actually rank technically ahead of them. And in those instances, we've lent at rates which are much higher than the yield on the bonds that they've listed. So I would say that alternatives, an investment in private debt doesn't necessarily need to have higher risk, although it might. And so the answer to your question is one needs to get down into the actual investment theses, of the manager and the fundamentals. If you look at our products, they've always been designed to be low risk, capital preservation centric type products, because our client base isn't looking, generally to make tons of money at high risk. They're looking generally to preserve their capital as a key tenet. Remember also, we're generally the biggest investor. And so our principles are capital preservation is rule number 1. Don't lose clients' money. And then make attractive risk-adjusted returns in that context is sort of the objective. So private debt, we would call the low risk side of the spectrum. And then as you move into things like equity investing and private equity and venture capital, so too the risk will go up.
Is there opportunity in the South African market? We know that the economy is under a lot of pressure. Are people still out there particularly private companies wanting to borrow? Definitely.
The activity in the market at the moment, it was very quiet through COVID. And then what we saw, I'd probably say about 12 to 18 months ago, Alex, locally in South Africa, is a significant uptick in requests from borrowers. But again, it's in specific niches. So the where we focus in South Africa is places where the banks don't want to be. We've got 3 focus areas in South Africa. The first is specialty finance. So any business that in and of itself is a lender. Banks don't love to lend to lenders because they see themselves as building out a competitor, which they would rather lend to the end user. So we're quite competitive there because there's a bit of a dearth of capital to that particular segment. We do a little bit of real estate lending, but it's got to be for a reason. Generally, it's due to complexity. And then investment holding companies are also very interesting for us because generally investment holdcos suffer from the NAV-rich, cash-poor conundrum. And so being a player who doesn't necessarily have to tick certain boxes, but that can look at risk differently, can allow you again to make what we think are very well covered lends, but by getting a little bit clever on the way you structure those loans.
And how do people find out about this? Obviously, we're having this conversation now, but companies, how do they know that there is this opportunity available, or is it something that they'll just stumble onto?
Yeah, so look, I think generally we're building a brand. In the specific niches that we operate, I'd say we're relatively well known. but we're not targeting or focusing on everyone. So if you're a borrower in the asset finance space, I hope you've heard about us by now as Westbrook. But if you're in a different segment of the market where we don't play, you might not have. As an investor, I think many people will have heard the Westbrook brand in the market. Many of them will associate our brand with Section 12J, which is the one product that we maybe made retail, where there were some ads on radio stations and billboards up and so on. We have intentionally not made the rest of our product offering as widely known because, to be honest, we're very niche in terms of who we're targeting as an investor. But the brand will grow organically as the needs of the business develop. And the easiest way to find out more is on the website, which is westbrook.co.za.
And just to kind of close off with, if you are investing, you're not investing directly into one business. Is there a portfolio of private businesses? In other words,
in
to
private debt,
risk?
yes. Yes. So there's an ecosystem in alternatives. Alternatives have funds. Some of those are open-ended, some are closed-ended, some are deal-by-deal syndications. There's all sorts. In our private debt funds, the philosophy, Alec, I mentioned capital preservation as a key metric earlier, or as a key philosophical concept earlier. There is no upside in debt, not the debt we're doing, right? Our debt funds don't include things like equity warrants and those kinds of things because we think it's too high risk. We'll put that in a different fund. So if there is no upside in debt, then it stands to reason that your focus should be on reducing risk as far as you possibly can. And the best way to reduce risk, aside from being good investors and applying the right principles around credit, is to diversify. So in the UK, we have 59 private loans in our portfolio. That offering is called Westbrook Yield Plus. In South Africa, we have 14. It's called Westbrook Income Plus. We will never have as many positions in the South African offering as we do in the UK offering. The market's just not as deep. But there are other ways that you can create diversification. Lending to lenders is a good one because they, in turn, have hundreds, even thousands of end user rental or loan contracts in turn.
You've opened our eyes to something. Dino Zuccollo, who is with Westbrooke Alternative Asset Management, and I'm Alec Hogg from BizNews.com.